Absorption and marginal costing. We already got a little idea about absorption, sir. Now we need to learn about marginal. Margin also we know, sir. The additional. Okay, let's see. Marginal and absorption costing. Again, profit statement and inventory valuation. Why? Sir, if you remember, even in the overhead absorption also, we have this IAS to inventory valuation based on the absorption. That's what is repeating here. Next, reconciliation. Nothing but re-verification. Verification. Okay, we know BRS, right, sir? Bank reconciliation statement, where our passbook and cash book, the differences between our passbook and cash book, we call that as a reconciliation. That's what he's telling. Clear? Next, introduction. Marginal and absorption costing are two different ways of valuing the cost of units sold and finished units in inventory. COGS and finished goods. Okay, we can value with the help of M and AC, MC and AC. Now, why? Because by the end of the period, that is, while you are doing the balance sheet, trading P&L, all those things, when you are preparing the financial statements, you will be considering these two costing systems, and then based on that, you will be evaluating the inventory. The same thing what we have seen in labor overheads. That's what, sir. Used for IAS 2. That's what. Next. The basic unit cost consists of different costs. The different arises due to the treatment of production overheads. He specifically mentioned what, sir? Production overheads. Now, absorption costing assigns both the fixed and variable production overheads. Of course, yes. Sir, we have considered both fixed and variable, whereas marginal always considers variables. Why? Even if you consider fixed, you are not considering the fixed. The amount is same, right? There is no involvement of extra level of activity. Yes or no? The fixed cost is not at all affecting the output, right? Whereas marginal was affected with that, right? That's what. Clear? Now, marginal costing. Any idea about marginal, sir? Marginal costing. Very good. Now, very good. Now, sir, the budgeted target of mine is to produce 1000 units. How much, sir? 1000 units. So, I can produce this in the first 3 months or the only first day, and I can produce this in an year, whole year, by distributing that divided by 12. So, how many I'll be getting? I can produce that each month. Fine. Now, on 31st of January, what I did was I have produced these 1000 units in semi-annually. That is, by the end of August, I have completed the production. Right? April, May, June, July, August, September. By the end of September, I have completed the production. Now, the most important thing you need to listen here is, after you have produced these 1000 units, there is no work, right, for labor or machinery. Yes. Now, on 31st Jan, what happened? I got an extra order of 200 units. 200 units. Now, even if I produce this extra 200, my factory rent is not going to change, no, sir. My machinery is not going to change, no, sir. So, at this point, the fixed costs are not changing. Whereas, for this 200, the labor, the material is, we are incurring extra, nothing but what, sir? Variable costs. That's what. The amount we are incurring to produce one extra unit of output, one additional unit of output, we call that as what, sir? Marginal, more than required. That's what he's telling. Okay. So at this point, there is no need to calculate or no need to consider the fixed costs, right? Whereas the variable we need to consider because that is affecting the production. Any doubts still now? Next. So please write this in formula book in a easy way, sir. In marginal, we'll be considering only variable cost. In absorption, we'll be considering both fixed as well as variable. Now, we will be considering the fixed production overheads as what, sir? Period costs. Here the period is whenever you close the accounts. Whenever you are closing the accounts, we consider that as a period cost. So in marginal, we will be considering the fixed production overheads as period costs. Clear? Next. Marginal costing. The marginal production cost is the cost of one unit of product or service, which would be avoided if that unit were not produced, or which would increase if one extra units were produced. You want to produce 1,000. In the middle of the year, you came to know that you doesn't have that much demand. So you have stopped your production. At that time, the production value is 800 units. Now tell me one thing. Can we call this as marginal? You want to produce 1,000, sir. But you have produced only 800 in place of 1,000. Can we call that as marginal? No. Correct. That's what. Whereas if you want to produce 800 and you have produced 1,000, yes, we call that as marginal. Clear? Now, the marginal production cost is the cost of one unit of product or service, which would be avoided if that unit were not produced, or which would increase if one extra unit were produced. That's what he's telling. Next, the marginal cost of unit of inventory is the total of variable costs required to produce the unit. Nothing but what, sir? When you are increasing the cost, marginal cost, automatically you are increasing the variable costs as well, right? When there is an increase in marginal cost, there is an increase in variable costs as well, right, sir? That's what. This includes direct material, direct labor, direct expenses, and variable production overheads. When you are involving in labor, automatically you will be involving in supervisors. Yes or no? In nothing but variable production overheads. Okay, next. No fixed overheads are included in the inventory valuation. Please underline this point, sir, in your materials. Sorry. They are treated as period cost and deducted in full against the profits for the period. So you won't calculate them as per unit or something. You will be considering them as a full for the period, not as per the production. Clear? Any doubts? Now, marginal costing is a principal costing technique used in decision making. Very good. The Soumya. This is a point you have discussed. Why? Because when you have purchased the raw material again, you are incurring some costs, right? Okay. Let's say, for example, if there is a order of extra 200 units, what we have discussed. This 200 units is giving you a cost of, sorry, the revenue of, my mistake, sir. My revenue of $40,000. But the cost to incur to produce these are 60,000. Will you be producing, sir? No, right? Why? You are incurring more 20,000, sir. Understood? That's why we should first know the cost, then accept the order. If there is no additional benefit, sir, additional production here, means you need to get what, sir? Additional benefit as well. So based on the production of additional, you need to get back additional benefit as well. Clear? Any doubts? So the key reason for this is that marginal cost approach allows management attention to be focused on changes. That's what, sir. The cost is a change here. Okay, changes which result from decision under consideration, whether to consideration, nothing but acceptance, whether to accept this or not. Understood? But my sincere advice, even though if you have qualified ACCA, even though they are willing to pay you thousands and lakhs of dollars, my sincere request, if you got a opportunity of working in government projects, even though the corporate is ready to give you $1 million per annum, sir, as a salary, but accept this. This gives you more reputation. Government projects has that capacity, sir. So even though you want to the cost, but the government in place of 1 million, they are willing to pay only 500,000 to you. Accept government only. Even though the work stress is high, accept government projects because it gives weight to your career. Understood? Just imagine ACCA Soumya, ACCA Shweta, ACCA Sriram, ACCA Harini are going to work for a government project. That is a great reputation, sir. Because government is selecting you, which is a very, very great thing. Understood? That's what. At that point, never ever consider the amount. Consider the reputation. And I believe me, you are going to earn double if you complete your project successfully. Understood? Next. To be frank, I can't tell you one country's name, sir, but I have worked for that country's government. Okay, not India. I'm telling you that. Okay, so it gives you more reputation, sir. Okay, next. Contribution concept. Now, the contribution concept lies at the heart of marginal costing. Of course, yes, because you are dealing with the sales. You have produced for selling only, no, sir, not to keep at home, right? So, sales, you will be selling those minus variable cost. Why? The marginal cost is always concerned with the variable cost, no sir, compared to fixed cost. That's why we will be getting what, sir? Contribution. Understood? That's what he's telling. Till now, any doubts? Next. Illustration 1. The following information relates to a company that makes a single product, a desk lamp. Now, sales revenue. Sales of 1000 lamps, sales of 1500 lamps. Sales revenue 600, sale of 1000, 600 into 1000, sale of 15, 600 into 1500. Direct material 200, 150, 50. 200,000 same into gives you this much, gives you this much. The marginal cost of production. Okay, now have you got that marginal cost of production, sir? 2 lakhs plus 1,50,000 plus 50 gives you 400,000. The same thing. 3 lakhs, these two plus 3 lakhs gives you 6 lakhs. So what is the contribution here, sir? 2 lakhs, 3 lakhs. Now the fixed production overheads are 1,20,000, 1,20,000, which is fine. The total profit is here is 80,000, 1,80,000. Now, contribution per lamp is how much, sir? 200, 200. Now I have a small thing to tell you. Sir, as you can see, you got more profit if you sell 1,000, less profit 1,500, more profit of 1 lakh. Yes or no? Yes. I'll be telling you one thing. Based on this scenario, if you produce more by not considering the demand, you will be in trouble. Why? Because if you produce, you need to incur carrying cost. You need to incur holding cost, warehouse costs. And you need to incur what, sir? The most important thing. The security of those in warehouse. Okay. Everything, sir. And if you doesn't consider the demand, it is very difficult. Understood? So consider the demand, consider the holding, consider the carrying, then only go for production of excess units. Just don't presume that you are going to earn more and more profits after producing more units. Okay. That's the reason why he already warned you this in chapter number 2 by telling about chapter number 3. 2 or 3? 3. EOQ and EBQ. Any doubts, sir? Fixed costs have been estimated to 1,20,000 based on the production level of 1,000 lamps and is expected to remain at this level. Of course, yes. Fixed cost is always a fixed cost. So profit per lamp has increased from 80 when 80 lamps are sold to 120 when 1,500 lamps are sold. Contribution per lamp has remained constant at both the levels of sales. Clear?